Hi, everyone. Thank you for listening today. I'm Raymond Ward, and I'm here with John Ward. Um,
Hello, everyone.
and today we were talking a couple of days ago, and we were talking about qualified plans and a lot of other things. But the qualified plans was something that seemed to take center stage in our conversation. So we thought it would be good to share our thoughts and maybe even have other new thoughts that about it. So, um, do you recall how it was that we got into it? Um, was the qual?
Well, one of the things we kind of picked up in that phone call picked up on more of the problem. And, one of the problems, what are the obstacles? I told you that I had written down, what are the obstacles to infinite banking for someone to take that on? And, I'm kind of thinking middle America, working for corporations, and these corporations offer this so-called employee benefit uh, as part of your package that we're going to give you 401k and we're going to do a match. Many of them will say they're going to do a match, which is funny, right? Because they'll do the match and during rough times, 2008, 2009, they did it during COVID. There was many companies that stopped doing their match. In fact, one of our sisters told me that her match got stopped during COVID, and I don't know how long it lasted. And I've never asked her actually if they started that back up again. But this idea that it's something they're giving you as part of your compensation, and then they can just say, "Hey, we're going to stop doing that." Like what? It's
Yeah,
like saying, we're going to give you a cut in pay, and you should be happy you have a job. As opposed to this fact that where I can get into all my kind of things about you know it's like any kind of relationship. You wake up that day and you say, I still want to offer my services to this company in exchange for their compensate. They're going to give me compensation for offering my services. But at different times employers feel like they have the upper hand, and at times the employee thinks, yeah, I can, there's so many jobs, that I can ask for the raise that I want. But, really, I've even instructed some of my clients at times to think about the idea of maybe next time you go in for, because they're using infinite banking policies uh, to store their so-called retirement savings, right? So they're not as interested in 401ks and the match and everything, and just say, hey, I'm making 100 and you're gonna, do 50% up to 6% of my salary. So you're gonna give me 3,000. Why don't you just pay me 103,000? You know, I'll just take the compensation. Well, we know it's because there's incentives to get all these employees involved so that the upper echelon, the executives, can get involved in the 401ks too. So they need certain amount of participation. So they're not saying, oh, do you want the three, in your salary and taxed and everything, or do you want it as this match, which of course it's not even vested 100% until maybe 5 years into the employment. So even what they so-called are giving you. And the reason I'm going through this whole thing is because these are the obstacles. One is, hey, I have smaller tax bill because, or I have less tax cost because I'm deferring some of my income into my 401k. And the other thing is, well, yeah, I'm going to put my money in there because they give me this free money. This match is all, considered free money. So that's kind of how I think we got into it. And then we started talking about things that we know that it's not free. First of all, it should be yours if they're willing to compensate you. But second of all, Uh, it's not a very transparent thing and what the costs are of these qualified plans, which I always feel like, as I said to you, I need to define what that is because that's our language. I don't know that it's every layperson's language. Qualified plans, again, are 401ks, IRAs. It doesn't matter whether they're Roths or not. They're 403bs. They're all those plans that are qualified under the jurisdiction of the government in their guidelines, right? So, and in the IRS, even the Roth could potentially, because it's their program, right?
Yeah.
That you've entered into an agreement with them. Yes, it's supposed to come out tax free because you paid taxes on the money going in. But we've talked about, because it's fitting under their roof, those rules can change just like they did with Social Security. Because you and I know that Social Security does get taxed by people. And I literally have talked to a number of people that just retire and they start collecting their Social Security and go, I had no idea that that went into some formula, right?
Oh, that
So
they would be taxed?
that they could be taxed. Oh yeah. I mean, it's not blatant. They're not just
Right.
letting
Yeah.
everybody know ahead of time.
Yeah.
If you go, it's buyer beware. You got to go and do all this due diligence on your own. But you'd think like, hey, I've been paying into the system, and they're not even really telling me all the rules. Well, the rules are there if you want to go find them, but you'll find them potentially when it's kind of too late.
Well, yeah, I guess you could say it's too late, but whether you find out before or after, the rules are the rules. Whether you find out now or you find out then, they're still the same rules. Now, you might, if you find out before you leave work, before you stop working, if that's what your plan is. I'm not advocating for that, but if that's your plan, it might be beneficial to know that you're going to be taxed if you make a certain amount of money. And believe me, you want to be able to, this is going to sound funny, but you're going to want to be able to be in a taxable bracket with your Social Security, because if you're not, that means you're living very low income, to not be taxed on it. So
Well,
yeah, you know what I mean?
ex
You know what I mean?
well, I do, yeah, of
Yeah,
course. If you're going to have taxable income,
yeah,
yes, which yeah, you'd want to be paying the tax in a sense because that means you're higher enough, you're making enough money, or
yeah,
at least,
yeah. You're
and
not
it still might not be enough, but
right.
but but to be clear about how I see it, right, is I'm trying to help people find a way to show no income in retirement.
You mean
And I
through
make
through
the
through taking, what base down to the basis points, right, on your whole life? Is that what you're referring to? I mean, that's
well,
one form.
yeah, I'm saying, yeah, to have things that aren't considered income by the government, by the IRS, in any money that does flow out of a policy or stream, whatever way you want to, it's almost like annuitizing it in a sense. Um,
Yeah,
but when you take distributions, you take it at cost basis, which is everything you put in, and then you take loans after that. So none of that's taxable and it's never put into the equation. It could literally put 85% of your Social Security income into your taxable income, 85% of it. So there are thresholds. So they give you some room, right? You can make so much.
yeah,
And once you go past that, all bets are off. It starts at 50%. And then once you hit another threshold, which is only, even for couples, it's only like another 10 grand. I can get into the exact numbers if we wanted to, but it's all there for the taking. It's easy. If you search on a term called provisional income, and some of it'll be provisional income calculation or whatever, you're just do a little bit of a search and you're going to find out it's pretty easy for a single person or a couple to get taxed on their Social Security. So my point about that was even Roths, though they're not taxable right now, uh, Social Security wasn't taxable when you and I were young, Ray. That's only been in recent years, maybe in the last 20, 25 years
Right.
that they
Yeah. It
started
wasn't always
taxing.
like that. Yeah. It's
What's
true. So
that?
yeah, it wasn't always like that. It wasn't always
Yeah.
tax.
Yeah. But it was
They
their
just changed the
program.
rules. Yeah, they changed the rules because they're in charge of the program. Yeah,
Yeah. They own the game board.
yeah. So
You,
I think when we were talking about this offline, a couple days ago, I used the analogy of I think it was Monopoly. Playing
yeah.
Monopoly, and somebody running the board, being in charge, and them deciding that they want to change the rules that are in their favor. Would you? And I said, would you want to play Monopoly with a person like that?
Right. That
Probably
they
not.
were only rules that they decided on. You had no input on the
Right.
rules, right? Like if you guys negotiated while you were playing Monopoly, like let's play a different way. Let's agree to play, nobody collects $200 after going past go. Like, okay,
Yeah.
it's fair. Both of us aren't doing it. But that's not the kind of game you're in. You're in a game where they're the ones totally in control.
Right.
And that's why you want to not be in their space when it comes to passive income time or retirement income, whatever way you want to put it. Um, because now you're in a place where you're either too tired or even maybe possibly unable to work. And now you're totally at their whim. And there's so many reasons why you might not want to. But, well, I'll stop there for a second and go back to the qualified plans, right? Because I want to stick on point here is the reason qualified plans come up in the conversation or in the minds of people that are investigating infinite banking is because they're wondering how they're going to fund these policies, right? They're like, I don't even know where I'm going to get the money. And one of the things they're doing is they are giving away the control and the compounding growth to many, many different banking institutions, whether it be for their cars, their houses, their credit cards, right? Their home equity loans. They're just giving it away. So that's one place. Well, we're trying to reverse that. And then the other thing is so many people have been sold. And I actually came up with this word today, not that I came up with it, but that struck me in the morning. I said exploited. That's really how I feel about a lot of government programs. I'm not saying all government programs, but financial stuff and even the financial industry. I feel like they just exploit the consumer.
Yeah. Well, think I think it's. I mean, you can read a couple of books, and you can, about this, that they're exploiting you. Barry Dyke's books come to mind right away. Pirates of Manhattan 1, 2, and three's coming out, and he's got other books. Excellent researcher. All the footnotes. I mean, you could go down that rabbit hole and never come out. I mean, as a layperson, I would get buried by it. But there's all these footnotes that you can actually go to that material that he's referencing, and you can come away with that feeling that you're being exploited all the time if you're in
Yep.
that market. If you are in those qualified plans, or if you're, um, you know, playing around in the stock market.
Yeah.
Yeah, it's being manipulated and all that good stuff. But
Kind of thinking about today's recording, our conversation today. I'd done some research yesterday and then I went in today to try to. So I was looking at, what people end up with in retirement. And they can end up with retirement accounts like 401ks and so forth and qualified plans, but they also could have stocks of their own. They could have bonds, and they could have mutual funds and real estate investment trusts. And I did some research and found, I took people from like 45 to 54 and then 55 to 64. And then eventually it got to be 75 and above. And these are surveys, and this is research that other people have done. And I'm not saying everybody's in qualified plans. I'm not saying everybody's involved in investments of this type, but it is kind of a mainstream thing for people to do, right? Because there's been a lot of talking heads trying to get people to move in this direction, which they've been pretty successful at.
been very, very
Um,
successful.
yeah,
In my
yeah,
opinion, they've been very successful
yeah.
in
Well, they're good. Yeah,
in
they own the airwaves, right? And we like to watch things on TV, and we like to, and
yeah,
we're advertised everywhere we go.
yeah. I will say
Advertised
that
to.
it's really great that we're in an age now though that we have things like this that we're able
Yeah,
to sit down and talk, and this can go out to other venues for getting this information out other than television. That you'll never hear. I shouldn't say you never, because never. You won't hear about it out on major networks about infinite banking or any of that stuff. Um,
no, that's for sure.
but
Uh,
you can certainly look all over YouTube and find as much material as you want to consume about this.
yeah.
Um, so
Well,
that's a
one of
great,
the things, yeah. Sorry, was that right?
because that's a great thing to be able to do that today.
Oh, yeah,
It can be a little confusing if you're hearing disparaging talk back and forth about, yes, do this, no, don't do that, same thing, no, different talking heads saying the same, saying different things about the same subject matter.
yeah. That definitely makes. The reason you and I became um authorized to represent uh, the infinite banking concept is we wanted to go to the source. We wanted to go. So we're authorized by the Nelson Nash Institute. Nelson Nash was the creator, developer, the pioneer is a word that some people like to use of this concept. And you need to go back to the core stuff because yeah, to differentiate yourself in the marketplace, in the marketing scene. People want to do a little bit of spin of their own. They want to tell a story, and sometimes it can beat up the same people that are trying to fight the good fight that they are. Back to probably a common scarcity type mindset that many of us have fallen trapped to, right? Fallen into that trap because, yeah, it takes a lot to, first of all, have the faith that, you're going to be all right. And so people are kind of stepping over each other a little bit here and there. But, so I want to go back to this little research I did. And, I'll just look at my notes really quick.
Yeah,
But
just
yesterday when I did it, I'll just say let's take more qualified plans. Let's talk about 65-year-olds, right? That's typically around the time, but I'll even back it up to 55. So 55 to 75, um, what they end up with is roughly, a $500,000, let's say 500, 600. on the median, right? So 50 percentile. So it means some people are doing better, some people are doing, half are doing worse. But
Yep.
middle of the road, that's the kind of money that they end up with. And when you think about the 4% rule, which is thrown around, and I kind of think along the same lines as Brian Bloom, I think 4%, we don't know. Let's be more conservative and let's go
Yeah.
with 3.5. And you
Yeah. I
can do
think
research on that.
yeah, I think even Wade Fowle will say that that 4% doesn't work anymore.
Yeah, I think it's pretty much across the board that people say it's not going to work. So you got to go with something a little bit lower. And even if you go at 3.5%, in the way you figure out what kind of income that would derive, and that's also keeping yourself exposed to the stock market, some of the bond market, having some money in cash. I think it was based off of 50% still in stocks, which means you got still quite a bit of exposure in the marketplace. But let's just say everything goes swimmingly and you can take 3.5% out of that 5 to 600,000. That really only gives you pre-tax of, anywhere from 18 to 20 for those 55-year-olds to 75 plus year olds.
18 to
And
20,
then
18 to 20 what?
18 to 20,000 a year. So
Oh,
you take your whatever your pile of cash is that's in your, say, your total investment portfolio, right? Um, and you divide that amount by the percentage of distribution, right? 3.5%. That'll give you the figure. That'll give you the annualized amount of money. And so it comes out to between 18 and 20,000. But as you and I know, they don't mention, well, yeah, but then there's taxes on top of that. So I went in and I said, well, let me look at, well, we know qualified plans, and hey, people can do whatever numbers they want. They can figure it out for themselves by listening to this, maybe taking some notes. But I did the qualified plans, the retirement savings that they had, and I took 25% of that. And I said, they might be in a lower tax bracket. Hopefully they are. But as you said, they're not going to have much money if they keep going too much lower.
right.
But then, well, I think 38 out of 50 states have a state tax. Luckily, I don't live in one of those states. And so I said the rest of it, I'll do 25% on the qualified plans, and I'll do 20% on stocks and mutual funds and so forth, because that's the capital gains tax right now is 20%, which of course they're talking about, depending on what party gets in, we know they're talking big time if the Democrats, again, not trying to be political, just telling it like it is. It's out there that those numbers are gonna be in the 40, around 40% for capital gains.
Mm.
So, wow, all the money that people think they've been making in the market through their buying their own mutual funds outside of qualified plans. Wow, they could really get whacked. So, what does that mean they're going to do with regular tax rates? You know, if they're willing to do it there, they do it wherever they can do it. So rates will probably go up if that side gets in. I'm not sure what
Yeah.
will happen if the other side gets in. But anyways, so that 18 to 20 went down to between 14 and $16,000 a year. So that's the median. And I want to clarify, that's household median uh, portfolios. That's how much they have in retirement at those ages, right? Doesn't mean the 55-year-old to 64 isn't going to continue to work. He or she's got 10 more years to add to their pile, all that kind of stuff. But the reason I did, and then I went today and I said, okay, so what is the average family may bringing home in Social Security, and it's around 3,000. It can be higher. It can be much higher, but we're talking middle of the road. So now we've got, you know, 36,000 on top of, say, let's even give it the high end. Let's say 16,000, right? So now you got 52. You've only got 52, and some of that Social Security could actually get taxed, but let's just forget about that. And I said, what is the median household making in this country right now? It's 78,000. So those are the same people. They're not different people.
Right.
The
Yeah.
78,000 is being made by the people that are still working in those age brackets from 55 to 75 plus.
Yeah.
You know, they fall in there and they're not even going to have the same kind of money. And that's where I feel they're exploited because of all the disadvantages of locking your money up.
Yeah.
Um,
Yeah. Just from the simple standpoint, I mean, this is part of the part of the element of IBC, but just from the simple standpoint, say you didn't even weren't even involved with IBC, just the fact that you have locked up your money, you know, in just say for instance, you know, you've been doing it for a while and you've got 100,000 in it, you know, after a, you know, so many years, and an opportunity comes along, but you don't have any cash, so like an opportunity comes along to buy a car, you know, that's undervalued, and you know you could make money on. Opportunities are coming along, and they're just whizzing on right by you because you don't actually have access to the cash. So it doesn't even matter whether you're doing IBC or not. Fact is, you've locked up your money,
yeah.
and if that's, you know, if that's the only place that you've been storing money, you know, you're probably using credit cards and probably and typically in debt to the credit card companies. And now, you know, with the interest rates where they are, I know they're talking about them coming down, but those interest rates aren't going to come right down on credit cards. Uh, so, so yeah. Now, if you were practicing IBC, the flip side is, and you had been doing that for a number of years, and just say a small farm here in Iowa comes up for sale, and you know it's $1 million for 100 acres or 1.5 million, and you've got a bunch of cash in your policy that you can access if you want, and purchase that property. Maybe it's a property that they needed to sell, so the price was lower, so it was a better deal, you know. And maybe if you have cash, you can negotiate a better price. But you know, it makes me think of the one of the things in Nelson's book about those with the gold make the rules, and the gold, aka cash, if you want to call it that. I mean, it could literally be gold, but let's just say that it's cash. Those that have the cash make the rules, and so anyway, whether you're being exploited with those or not, um, those opportunities. That's how you grow your wealth, by living below your means, um, and you're saving cash somewhere that you have access to it, and it has a guaranteed growth. You know, you might say, well, I could put it in a high interest rate savings vehicle, but are you locking it up for 90 days or a year, or you know, is it just liquid? And if it's liquid, well, great, but those aren't going to be around forever. That fluctuates too in the marketplace. um, yeah, one of the things that we had talked about was the Roth IRA. You know, that the fact is that you're paying with you're putting money in there after you've paid your taxes. So that's good, but you're still locking it up. And oh, I wanted to say that earlier when we first started talking, you said something to the effect that, yeah, and there's certain things that we know about how it really works. And so it makes me think of Todd, that Todd has made videos showing how this whole match thing really isn't all that it's cracked up to be. That over time, that match gets eaten alive because of all the fees. And when I say all the fees, there's fees that they show you, and then there's fees that they don't have to show you. Um, and even if it's only 1% here and 1% there, over the course of time, that eats a huge amount of value up. And also the other part of this is that the market can go down and draw that qualified plan down. Whereas with the whole life policies, when they pay that dividend, it becomes part of the contract. It's part of the contract. It never goes down. As
It's
Nelson
under
would say,
lock and key, really. It's under
what's
lock
that?
and key. It's under lock and key. It never goes away. It's never subject to diminishing, right?
Oh, yeah, the IBC, yeah, the policy.
Yeah.
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 Um,
Once that dividend goes in, it's locked in.
yeah, it
And it
never.
only grows from there.
Yeah, and in Nelson's when some of the practitioners got together and they made the documentary about his 2 day seminar. In that 2 day seminar, he says this is like the story he used because being a pilot, he thinks of airplanes all the time. So he said when a jet plane takes off, it's at the lowest efficiency. As it flies, 200, 300 miles out, it gets more and more efficient. It gets better and better. It has to just naturally because it's burning the fuel. So it gets lighter and lighter and lighter and it gets more and more efficient. And he says, and that's exactly what happens inside these policies. They just naturally get better and better.
It says
And you can
people are
see it.
not familiar with things that get better. They're not.
Yes, and he says that most people can't wrap their mind around something that gets better and better and better. But like they say, when if a jet plane takes off, it's a 747, and they discover something wrong with it, like, oh boy, we better turn around and get back and land back where we just took off from. They don't want to necessarily land right away. They want to fly around a little bit to burn up some of that fuel so they're not so heavy when they hit the ground.
Yeah,
And
that's why
that's
it's
and
not.
Nelson talks about that. He talks about that in the video. So that's a plug for people to go get that set of videos. It's three DVDs. I think you can actually buy it as a I want to say a wireless kind of thing. You can just download it or something now.
Oh,
Yeah, your mic is a little bit low there. I don't know what happened to the sound, but
yeah, it's funny. Some things with
yeah,
my laptop seem to come in and out.
yeah,
Yeah, well, back to the airplane idea, he also talks about controlling the environment. And, you might not be able to control the weather, though some people might be able to. uh, you know, do you want to fly at certain times because, hey, I've got a headwind, you know, in this pattern, in this fly pattern.
yeah,
And if you just wait a little bit longer, be patient, it's going to turn around and it's going to be a tailwind. And so we might not be able to control those weather patterns, but we can control the financial environment, our own environment
right,
within our financial world. And that's what this is about, right? That you're going to be in control. And the people like to say that's what one of the things you're taking back control. And people don't even know that they've lost any control, really. you know?
Yeah,
I
well,
think
that's
this is,
only because we've grown up in this environment, and so it's kind of like
yeah,
the fish in the fish bowl, right? He looks out and he see, looking around, but he
yeah,
doesn't realize that he actually is inside of this bowl, and there's a whole other world out there. That
yeah,
we are like that in the sense that this is the environment we've grown up. The banks are here. This is how you do things. 20% down, da, 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 mortgage insurance and all that. And oh, and by the way, we have these 401ks and you know,
yeah,
uh, what was interesting. I just and maybe I can put it in the show notes here. But there was an article that came out that just said it was probably just last week, late last week, that there were so many, a whole bunch of people, I guess, I can't even remember what the number was, but that they had all become millionaires in their 401ks.
yeah,
And
you've
it was a
mentioned
big
that.
number of people, enough to write an article and make it seem like it was an exciting time for them. But depending on their tax bracket, it's really not a million. And depending on their age when they'll get it, that million might be there today, but it could be gone. If a 2008 comes along,
And it's still taxable. Even if you lost 40% like
it's
in
yeah,
2008,
whatever's
then
left
the,
is still taxable.
yeah, if $1 million is 600, this, they're not going to say, hey, sorry, you lost in the market, so we're not going to tax you. They're still going to tax that 600 if you
Yeah,
try to take it, right?
yeah, yeah,
So yeah,
yeah.
you're subject to whatever happens in the market. But I want to jump a little bit and go to once in a while we talk about our family members, which I've already mentioned, a sister, but we have another sister and her daughter um, was introduced to the infinite banking concept by me and our niece. And people do what they're gonna do, right? Because they think, you know, I'm getting all kinds of advice from other people, and I've got this 401k, and she's the head of HR, so she probably got wind of the fact I can take a loan from my 401k. And people are like, yeah, I can take a loan. I can take, well, yeah, okay. It's limited to 50,000, which might be enough for whatever loan you're going to take it for, right? Um,
Yeah.
and then when I pay it back, I pay myself back. Well, thank goodness, because you just took 50,000, for example, out of the market. So the whole reason you were in the market was so that you could get these returns. Well, it's not in the market while you borrowed it. But in a policy, if you were to borrow against your cash value is still there. You're just using that as collateral to take the loan from the insurance company.
Yeah.
So you are still in the market, even though it's not the market. It's still subject to receiving those great dividends that come through or have been coming through for over 100 years. So, but one of the things that struck me was you can only take the 50, but let's say you took 20 and then you lose your job, which I honestly don't know. I haven't checked with our sister and checked with our niece, but I know that she was shutting down that company. She was doing all the letting go of people, being in
Oh, our
HR.
niece was, you're saying. Yeah.
Yeah, our niece is, so she was going to be the last to go. That's what happens, right? They keep you around as long as you can still do a job for them, which is saying goodbye to a bunch of people, giving them the bad news, and then you're gone too. And when you have an outstanding loan from your 401k, you have a certain amount of time to pay it back, but it's only the next tax year. Now, it can be an extension. You can go all the way to October. But let's say this happens in December. then you have about 10 months and whatever amount you have outstanding, which easily could be up to, close to the 50,000. You've got to pay it back or it gets added to your taxable income that year.
Oh,
That's a big deal. Why am I beating up on qualified plans? Is because they're not transparent. They don't let people know all the pitfalls that are potential in their path, right? They just don't know these things. Yes, could you learn that about a loan when you took it out? Yeah, hopefully you did, right? That, hey, if I get terminated, well, termination isn't always because, hey, we just feel like firing you. And it's the same if you quit your job and you've got an outstanding loan. So don't, you were in at least somewhat of control of that, but they can shut down a company. And that's what was happening. I'm pretty sure she had taken some loans. And
hmm.
I just feel for people that there's so many gotchas, so many places to trip up. And I like simple. I like simple. I like what you said. If something comes along because you have the cash and it makes sense to you, there's at least in our lifetime, hopefully it'll always remain that way. There's no shortage of opportunities to turn a buck, to find something where you can buy low and sell higher. And it doesn't have to be just throw it blindly into the stock market through mutual funds in your 401k and IRAs, right?
Yep.
Which is what I think most people are doing because they're not they're just looking at, hey, what's the 10-year history on this mutual fund? How's it done? How's it done in the last 6 months, the last 5 years, the last 10 years? Because they give you that kind of information. And that's really what I picked my 401k mutual funds based off of those things, right? Or hey, let me get a European fund and let me diversify a little bit. But I didn't really say, hey, these are all the companies that I really want to invest in. I was like, hey, I'm just trying to, get a pile of cash someday when I retire.
Yeah, you were
And
basically doing what everybody else was being told to do. You were told the same thing, and
yeah,
knew that this was potentially a way to grow your wealth. Um, but I think that you're certainly growing somebody's wealth. Um,
there's no doubt about it. And that's where I think we don't even stay conscious enough to understand that just like when we put our money in the bank and store some of our emergency money or just savings, we don't understand that we're lending our money to them. And then when we need it, they turn around and charge us more, much more for it than they're willing to give us for ours.
yeah,
And the same thing is what we're doing with the stock market is that we're lending our money to all these people, including the companies that are charging us fees.
yeah,
You
yeah.
know,
Um,
they're charging us fees. And I think well, when I put up my show with this recording, I'll put in a link to Todd Langford Truth Concept Software in a video he did on qualified plans. And he shows exactly what Ray mentioned earlier, which is when you think you've got this match and he plugs in, I think in that example, he plugs in 2% management fees. And let me just say something about that before I finish. That thought, management fees in mutual funds, the mutual funds are owned by a whole nother company than the company that's managing the 401k, right? There's usually a custodian company. I think one of mine was called Longfellow, and so Longfellow is managing this for the company you work for example, they're charging fees. They're not doing this for free. In the mutual uh, fund company, let's say like a Fidelity fund, well, they're making money too. You add those things together, and that becomes what Todd in this video that we'll show a link to talks about as the management fee. When he plugs in the 2% and then basically hits enter, it shows so much of the match that just disappears. The tax deferral money wiped off, and literally he shows a shift of about, I think it was 1.4 million. Started at 3.6 is a total growth of the
Yeah.
portfolio, and it goes down to 2.2. I mean,
Yeah.
it's shocking.
Yeah.
But
And
yeah,
that now his software has, since he made that video some time ago, his software now is much more, I want to say it's client friendly, in the sense that if you and I were to share it with a client, not that we share it a lot, but we if we decided we were going to share it, that and the only reason I say that, if we decide to, is that um, confidently we can say these kind of things because we've already looked at all the calculators and show this. But now his calculators actually show it in a much simpler way of seeing it. You can actually see that, yeah. So you went from what'd you say, 3.6 to 2 point whatever it was.
sure. Yeah,
And then now he's got this other button where he says, okay, what is inflation? And so you
sure.
plug that in, and then it drops even further. Yeah, so yeah, I guess we are hitting the qualified plans pretty hard, but I want to say that if you were to do this, compare a qualified plan, same money that you put inside of a policy. He also does that too in videos, and you can see that the policy or policies, that's the other part of this whole thing about IBC, is that it's a system. It's a number of policies that become a system. But you can see that the numbers are, it's well, I have a friend who's also in the same business, that she has told me that I've gotten more clients just by showing that video, or making a video with their numbers, the client's numbers, to show what it's really going to do
Yeah,
over time. And inflation is definitely something that you cannot ignore.
yeah,
Anyway,
yeah. Well, we were talking, I think yesterday, and I talked about a company called Motley Fool. It's because they did an article, I think it was just this year. I think it was in April, but I'm not sure. And it was about, uh, you know, having $1 million in retirement, and the people that are coming up on retirement now don't have $1 million, but we can show you the way. If you just put a little bit more money into the market, you'll end up, when you're getting 8%. Nowhere in that article, Ray, did they say anything about, because they literally said X amount of years, like 30 years, 35 years, you put in this amount, which was not a huge amount, but it was, payments into the system and into your portfolio. And it came out to like 992,000. They said, "Oh, there's your $1 million." They don't say anything about the fact what the tax rates are today, what the potential changes are for taxes, right? Just like I said, depending on who gets in, it's already been said with the Democrats that capital gains is going to go to 40. I mean, then you could have state taxes on top of that. Some states have 10%. You can be 50% of your income, it's gone. So, um, anyways, income and portfolios and all that kind of stuff. So you've worked all these years for it. And what struck me when I was telling you yesterday, I said, I know Motley Fool's been around a long time. And I wanted to see when they were founded. And they were founded in 1993. So I said, my gosh, that's that's over 30 years ago. And let's take a 65-year-old, right? They were
Yeah.
35 years old then,
Yeah.
right? And why do we, with all these so-called financial gurus and know-it-alls, right? That are really just marketing machines, you know, how is it that we still have people ending up with, so little to take them into retirement? Because we've had these guys advising people all over the internet for the last 20,
30.
25 years,
Yeah. Yeah.
you know?
Yeah.
And that's the thing. We have a lot of sort of ill advice that's given to people because that's like, again, it's the core of the marketing message from Wall Street is coming from these marketing machines and putting out articles. And so you do a Google search and those things pop up, and then you think it's the gospel. You think it's the only way, right?
Mm-hmm.
And they don't even tell you the whole truth. For them to not say anything about taxes is criminal as far as I'm concerned. It's absolutely criminal because it's not their money. Who cares about $1 million? It's really about what the $1 million is going to buy,
Yeah.
what kind of life you're going to have.
Yeah. 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 So, the thing of it is, if you were putting the money into a policy, a properly designed IB policy with a mutual life insurance company, Todd also shows how that grows over time. And your friend Brian Bloom, writing that book, what is it, the capital equivalent? You
Capital
know,
equivalent value of life insurance.
yeah, yeah. Confessions of a CPA.
Yep.
That's just great. That what is what's really happening inside of a policy and what's really happening inside your qualified plan, and comparing the two. It'd be if you just made the one change. Okay, here's that one change thing again. If you just made that one simple change of actually first putting your money through the life insurance policy and then taking it and going out and buying some a stock or some stocks or something like that, or even start funneling, maybe funneling some of it to a 401k. I mean, this sounds crazy, I mean, even saying it, but if you really wanted to do that. But first, if you put it inside the policy, you're and you're you're taking that one step that money is always going to be growing, even when you take that loan and put it over there. And that's that one difference. But if let's just get rid of the whole idea of qualified plans. If you just did that instead of putting it in a savings account at the local bank, if you did that, and then an opportunity comes by and you have access to the cash, quick access, you take advantage of that opportunity, and now your money is making money in both places. And as you pay it back, now just say, for instance, an insurance company, anywhere from 5 to 6% is what they're charging, because you're taking the money from their general fund, you're collateralizing your death benefit.
Yeah.
So you take that money and you pay it back into the general fund, so to speak, and they're charging you 6%. but pay yourself back at that maybe 2% more, just a little bit more. The same thing that you would do if you had taken it from a local bank. Depending on what it is that you're investing in, they might charge you a higher amount of interest. So just be, as Nelson used to say, just be honest with yourself about it. The
Yeah.
other thing is that you've made this point before, is that when you do that kind of thing, paying yourself back, you're paying back the principal and the interest into something that you own. And that principal that you're paying back is there for you to use again for the next opportunity that walks by in front of you. Um,
Yeah. Yeah. Like if you're making $100 payment into your policy loan, immediately you have access to that $100 again.
yeah,
That's dollar for dollar.
yeah. Like my particular policy, I have a loan out on it. And so what I just started to do is I literally send every Thursday, I send $100 back. And and you can literally see the cash available for the loan go up by that $100
Yeah.
as soon as I do it. As soon as I do it, I look back in. I do it, go back in, and I can see that it's up $100. The available cash for loans, and yeah. So anyway, so
Yeah, I like to use the example of $100. I mean, we can do multiples of it, but you could borrow $100 from the insurance company, leveraging your cash value, and that $100 could go out and do something for you in your business, for example, right? And because you invested that $100, you keep, turning it over. Maybe it turns into 200 or 300, and you pull out the 100, right? You say, well, I put 100 into that thing and I made a profit of 200, let's say. And all you have to do in an annualized basis to keep using that $100 over again. Let's say that happened every month. You just take that 100 back out, say, oh, let me take my cost basis. I've got my growth, my 200 in growth. Now I'm going to throw that 100 back in to the system, into my business again, and have that turn out 2 or 300 bucks, whatever it is. I'm not saying it has to be 2 or 300 or two or
yeah,
three
it can be,
times,
yeah, it's just an example. Yeah.
but all you have to do on an annualized basis to keep leveraging that $100 is to pay roughly $6 right now every year for you to keep churning that 100 through your money machine, your business machine, whatever that is. I mean, you're paying a fraction. But people, what they do without one of these types of policies is they just pay that $100 every month. They, whatever that cost is, right? They just keep paying it. They just keep paying it out. You're using somebody else's $100 is my point. You're not using your own $100. And because that 100 made something, not only as Ray just said, it's making it inside the policy because you didn't take yours. Yours is still sitting in, your 100 still sitting in there making money. Now you've taken the insurance company's 100 and you're making money with that. I mean,
Yeah.
that's, I mean, there's multiple ways to do it. You can get more than two uses out of the money, but let's just stop there to keep it simple. And basically it's an interest only loan, is what I'm saying. You literally can just keep using that money and paying a fraction of what you would just give to somebody else every time you spent your own cash. Again, you're not spending somebody else. Your only cash outlay is the interest that you're paying back to the insurance company.
Well, what do you think? Um, I,
Well,
I can see
I
the sun is setting on
yeah,
on my face.
it's pretty close to set here. You're right. My light's starting to shine down on me. Um, yeah, I just I guess I think about, I wanted to say one more thing that you and I talked about, which is, and I'll say it briefly, is this idea of 2008. And it was really uh yeah, before George W. Bush was out as president, right? Because that, people have to remember that that's what happened. It was just before Obama went in. We had the beginnings of the crisis, but it wasn't the complete crisis that we ended up having shortly in 2000, 9, when he first got started, right? Um, and I took out my money in my 401k out of mutual funds, out of the market, and I put it into the money market that was available through the 401k, because I just didn't want to watch my savings disappear, right? And not many people do that. Uh, People feel, I think, trapped. Someone like me, even, okay, you're trapped. Like, when do I go back in? And they feel trapped that, well, if I take the money out now and the market goes up, then I lost my chance to get the money back. These are all the mental, you know, uh,
Gymnastics.
gymnastics. Thanks. That was the word I was looking for. It's all the mental gymnastics that you have to go through. And then you've got this partner that someday steps in and says, "Hey, we're ready to take part of the business. We need our return now." And they can decide what percentage of the business they want. And you did all that potential agonizing. And what we're saying here is that isn't the way it has to be. In fact, put your money, pay yourself first, put it through the policy, pay taxes on the seed, and let all that growth of the harvest be tax free, right? Just,
Mm,
pay now so that you can focus, which is another thing Brian Bloom says, is that it's much more important to focus on the distribution of the money. And all the focus on Wall Street and otherwise is on the accumulation.
right.
And there's so little talk. And Ray and I can talk to you about the distribution side and why a permanent whole life policy based on the infinite banking concept can be fruitful throughout your life, but then be fruitful in your passive income time too, and lower your tax burden, because none of that's going to get into any provisional income formulation. And Medicare. Medicare gets affected by your income too. So you pay a lot more, 3 times as much as some other people would. So you're going to have cash flow. Don't get me wrong, but you're not going to have income, which means it's not in the jurisdiction of the IRS. So I
Yeah, right.
guess we could leave it at that.
Well, that's a good place to finish up. Yeah. So, well, thanks for sharing all your thoughts, John. It's good to see you again, and we'll have to do
Yeah.
this again soon.
It's good to
For
see
sure.
your cat going by every once in a while too.
Yeah, that's Bobcat. Yeah,
That's what?
that's Bobcat. He likes to get in on the show every now and then.
Yeah.
I
Yeah.
have I have other talks that I've had with other folks, and yeah, he'll walk by me in the back.
Yeah. He doesn't even wave though. He doesn't say hello.
Yeah, yeah, yeah. He's not worried about qualified plans or
Yeah, yeah, yeah. He's not worried about the environment either.
anything. No. Anyway, well,
Yeah,
thanks,
it's
and
good to see you too, Ray.
yeah,
Thanks for the time sharing. This is fun.
yeah, it is.
Hope everyone enjoyed it. Thanks everybody for listening.
Yeah. Please do reach out if you have any questions or if you'd like to talk about this in more detail. um, and we'd really appreciate it. We love to hear from folks that are listening. So you'll see our contact information in the show notes. So anyway, thank you very much, Johnny Ward.
Thank you, Raymond Ward. Bye.
Bye bye.